Good evening, everybody. I think it's now close to 5:05. And we'll start the quarterly webinar. Welcome to Kotak IPO Opportunities Fund quarterly webinar for the quarter ended September 2024. The format of the webinar remains the same. We will run you through the overall portfolio, give you an update on the portfolio, and we'll run through each portfolio company that we currently hold in the fund, covering the details about the performance as well as how we are looking at exits from some of those portfolio companies. If you have any questions, you can keep it till the end, or you can populate the Q&A bar at the bottom of your screen, and we'll address those queries at the end of the webinar. So we'll start off with the fund overview. As you are aware, it was a 2,000 crore fund. We had drawn down about 1980 crores out of that, and since there were limited investment opportunities at a decent valuation, we had returned some amounts of capital from the last drawdown back to our investors. So today, as it stands, we've got invested capital of about little more than 1,500 crores. And the outstanding value of that portfolio is about 1,673 crores. We have distributed, including the unutilized capital, we've distributed about 414 crores back to our investors. The MOIC, multiple on invested capital for the portfolio, currently stands at 1.2x. Just to caveat that this is basis the valuation that we have done independent valuation that we last done in as of December 23. We will be revisiting these valuations again in the next quarter, and the fresh numbers will be released to investors by shortly by the March quarterly update. You will have the fresh valuations as well. Next slide. We currently hold about 12 investments in our portfolio, of which currently 3 of them are listed, which are Swiggy, TVOTech, and Aadhar Housing. The others are currently, they're still unlisted, and we'll take you through each of the portfolios. On an overall portfolio, on the unrealized portion, we are currently sitting at about 1.1x basis the December 23 valuation that we have done. And the exited portfolios which are companies which are already listed, which are Policybazaar, Sion, Nykaa, Tata Technologies, and SBFC. On that exited portfolio, though the invested capital was limited, we did about 1.8x on that realized portfolio. Next slide. As a practice, we had started, because our valuations were slightly dated, external valuation, we started looking at where other market participants are marking some of our portfolio companies have. So there were only about 3 companies where we've seen a certain movement, which are Pine Labs, where we have currently marked it down from 1.38 to 1.17. I mean, some of our peers have marked it down to 1.17x, which is Invesco and Baron, who have marked it down. We've got NSC, which has seen a significant uptick in the valuation as compared to the December 23 valuation that we have done to about 2.26x. This roughly translates to a share price of 1,400 rupees. Some trades are happening at higher prices as well, but we have marked it at about 1,400 rupees. On a pre-bonus, this will roughly translate to about 7,000 rupees per share, equivalent number. And then we have PharmEasy, where we have done this valuation exercise last year and marked it at 0.47x. But to show conservative valuation, we marked it down to about 0.19x, which is effectively the rights issue price of 4.84 rupees per share, which was done in late last year, September 23 last year. So if we were to market at that valuation, what would be the impact on the portfolio? Based on these movements, our overall portfolio changes from 1.1x to 1.19, largely on account of the movement in NSC. And an overall portfolio MOIC increases from 1.12 to 1.2x.
Swiggy.
Yeah, and Swiggy as well, as compared, Swiggy is not changed between 1 and 2.
Yeah, okay.
This quarter has been slightly muted as far as investment activity is concerned. It's seen a nearly 45% decline in overall investment activity from 16 billion to 8.8 billion. And in that also, the PVC space has decreased from $12 billion to $6.5 billion. likely reasons are that the valuations on the unlisted sides have continued to remain high. And alternatively, some of the larger companies are opting to go public rather than raising rounds at at a lower valuation, which some of the growth funds may be demanding. So most of the investments have been maybe deferred. Maybe we'll see an uptake in this quarter or the next quarter. Exit activity has picked up pace in line with the IPO activity as well. Exit splits, if you see most of our the level of activity has increased from, from a 6.3 billion in the last quarter to over 8.2 billion increase in this to $8.2 billion in this market. Open market sale and IPO exits have accounted for a large portion of that. Nearly 50% of the exits have come through that as well. The 4.2 plus points are about $5 billion of exits have come through open market and IPO exits, which is what we hope that this activity continues, as some of our companies also prep themselves to go public in the next calendar year. We will also try and capitalize on some of these exits in the next calendar year. On the macro front, things have been looking better with the interest rate reduction in the US and a few other geographies. We'll have to wait and see how the new administration in US does it continue with the rate reduction and what its impact will be globally. On the market front, global markets, especially the US markets, have seen all-time highs. Both the Nasdaq and S&P have scaled to new highs in the last quarter post the election results in the US. India market has seen some level of corrections because of the elevated valuations as well as the muted results that some of our companies have shown, and therefore the markets have taken a hit. But from a flows perspective, though, FPI exits have been fairly high in the last quarter, which has been compensated to a large extent by the domestic capital flow. DI flows into the market was and nearly compensated for the entire outflow from the FPI in the last quarter. So while India's story remains strong, macroeconomic factors on the India front remain strong, but some of the higher valuations, we may see some amount of corrections in the equity capital markets. But overall, I think the markets, some of the market corrections may already be done. Some may still come through in this quarter and the next. So in the next few slides, we'll take you through the performance in each of our portfolio companies, starting with Pine Labs. Pine Labs, as you're aware, is the largest player in the POS machine segment in India. It has got other segments like the buy now, pay later and the prepaid card segment as well. FY24 was a muted year. Actually, the first half of FY24 was very, very disappointing. They made up for that in the second half of the year, and they closed last year, FY24, at about 9% growth. This company has continued that growth that they saw in the last two quarters of FY24. They've continued in this first half of FY25. They've shown 32% growth year on year, and they've delivered about 17% EBITDA margin. And if you look at the absolute EBITDA number of 185 crore, which they did comparable what they did in the full year of FY23 as well. A company has guided towards delivering close to 325 to 350 crores of EBITDA for this financial year, and they seem to be on track to achieve that. On the exit front, as you're aware, that this company is a Singapore headquartered company, and they had initiated the process for redomiciling the company back to India. The process is continuing along expected lines, and they're expecting to conclude this by March 25. They've also parallelly initiated discussions with IPO bankers and initiated all the processes to be followed for an eventual IPO. Company is guided towards filing the DRHP soon after their de-domicile process is completed by March, so maybe by the June quarter or thereabouts, they will file the DRHP, and with the IPO expected in the second half of CY25. Surgeon Medical is one of India's largest medtech players. They are a stent manufacturer, cardiac stent manufacturer, and with presence in India and in Europe and other emerging markets. Again, this first half, they've shown growth of close to 12%. They faced some issues on one of their products in the European market, which is behind them now, and they've now been able to get back to the growth trajectory. They seem to be on track to deliver close to 150 to 180 crores of EBITDA in the full year of FY25. They've delivered about 76 crores in this year, this first half, and they seem on track to deliver between 150 to 180 crores for the full year of FY25. As you may be aware that they were looking to do a strategic sale of the business, but the company has decided to pause that process in light of the better performance and the expectation that their full year number for FY25 and their projections for FY26, they expect that they should be getting better valuation than what some of the strategics were willing to offer at this point of time. And therefore, they are prepping themselves to go IPO in sometime during CY25 to early CY26 timeframe. So that's the current plan with the company, and we expect that the exit from that will be much better than some of the strategics were willing to offer at this point of time. The product portfolio is clicking all across. Their core stent portfolio is also growing in different markets. Tavi, which is one of the newer products that they've launched, was also showing strong growth in various markets as well. So we are hopeful that FY25 will be a good year and followed by a better FY26 as well. National Stock Exchange, I'm sure I don't have to give you an introduction. The business has grown significantly in this year. First half, they've shown about 36% growth with a significant improvement in the EBITDA and profitability part as well. However, some of this growth, a large portion of this growth has come on the back of options, both indexes as well as equity options. And therefore, SEBI has come down with certain regulations to limit potential, impact on the option. Just recap on NSE. As I was saying, the growth in NSE was about 36% on the back of increased trading activity in the first half of this year. And that because of a lot of that volume growth and revenue growth has come on the back of index option trading, and SEBI has come down with certain regulations which would impact the overall volumes in that segment. One of the change in regulation was that every exchange can have only one contract on a weekly expiry, and everything else has to move to a monthly expiry. NSE has decided to go with the Nifty as part of their weekly expiry and move all of the contracts to the monthly. So Bank Nifty, which used to contribute about 40% of their option volumes, has also shifted to the monthly expiry. The impact of this is yet to be seen. For the last 10 days of November, we've seen a 20% drop in overall volumes. The management has guided that there could be as much as a 40% impact on the volumes, but we'll have to wait and watch if some of those volumes move to the monthly expiry or some other contracts. But for now, we've seen about a 20% drop in volumes. There could be a significant drop in the profitability as well on account of these drop. The full impact of this will be seen in the December month, and then followed by in the next quarter onwards, we'll see the full impact of this. But there could be a 20 to 40%, 30% drop in the profitability of NSE. But that hasn't stopped the secondary market activity in the stock. Investors are continuing to pile on the cap table at this point of time, seeing the pricing has moved over the last few weeks as well. The price has moved from 1,400 to close to 1,700 rupees in the secondary market. We'll wait and see how the overall impact will be, but there should be a 20 to 30% impact on profitability come the March quarter. Easy, there has been this year was supposed to be a year of growth or restart of their growth trajectory. They raised capital last year for about 3,500 crores through the rights issue as well as from Manipal Group. One part was to repay some amount of that mezzanine debt that they had. The other part was to invest in growth engine for the company. But the company has spent the last 6 months as well on cleaning up its B2B business, which is their distribution to hospitals as well as to distributors. And most of that cleanup is done at this point of time, and the company is expecting the second half of the financial year to see some level of growth in the business. Some of that cleanup activity has resulted in some one-time costs, which has impacted the profitability at an EBITDA level from last year to this year. Again, we were expecting a better year on the profitability front as well. However, we're not seeing that as yet. We're hoping that the growth will come back, and that will improve the overall margins of the business. From an exit, at this point of time, we don't have any visibility on the exit front. They will be redoing another round of funding early next year. And we will see how and who are the investors participating in that round, and we'll revert on our exit strategy at that point of time. Now I'll ask Nidhi to go from here.
Yeah. Hi, good evening, everyone. So on Swiggy, the company recently got listed. On the day of the listing, despite Nifty being down, the company had a good opening and ended the day with a 19% up. Today also the stock is almost at 500 rupees. They also came out with their numbers today. We haven't had a chance to deep dive into the numbers, but prima facie, the company has reported a 30% YOY growth on an overall basis and a 12% quarter on quarter. So growth is really kicking in for Swiggy. And even in food delivery and Instamart space, numbers in terms of growth are very similar to Zomato. In food delivery, they delivered a 22% YOY growth and a 4%. Sorry, apologies. I think today the tech gods are not shining on us. And we're really having a lot of tech issues. Hopefully, this will go smoothly from now on. I'll just recap on Swiggy. The company listed in November. Yeah, the company listed in November, and even on the listing day when Nifty was down, the company had the open as well as ended the day with almost a 19% up. Today also Swiggy from its listing price of 390 rupees, from its IPO price of 390 rupees, is now at 500 rupees today. The results of Swiggy came out. Sorry, is there a tech issue or it's fine? Yeah. The results of Swiggy came out today, and they have continued on their growth path, very similar to the way the Zomato has delivered its Q2 numbers. The company grew 30% YOY and 12% QOQ. On the food delivery side, 22% YOY business and a 4% QOQ growth. And profit also doubled from 60 odd crores last quarter to about 120 odd crores this quarter. So seeing strong growth in food delivery. Even Instamart was even better in terms of growth, 20% quarter on quarter growth and a 136% YOY. We have to dig deeper into the numbers, as the numbers have just come just before our call started. However, we're very happy with the performance. We do not have any lock-in in this company and can exit anytime we want. But given the performance that it is tracking, we are tracking, and we will see when to exit. And we'll take a call on the company. Even the broker reports that have come out, which have been few as of now because they have to finish, there is a certain regulatory guideline as to when those broker reports can come out within certain days of the IPO. As more and more broker reports come out and cover this company, you will see more and more price targets coming out. We are quite bullish on the company. Moving on to the next, that's my interesting. Yeah. On Daily Hunt, again, some interesting and good milestones to report over here. The company had, for the first time in its history, clocked a 300 crores of revenue per month. And this is, of course, on the back of some inorganic acquisitions, which have been made at a very sweet valuation. And these are break-even to profitable companies, which they have added under their small tuck-ins, which they have added to themselves. The other milestone, which is very good to hear, is Josh. Josh became gross margin positive and is well on its path to becoming break even very soon. So overall, while Daily Hunt clocks about 14 to 15% EBITDA margin, Josh, which is burning as of now, has consistently reduced its burn. And so on an overall basis, also you can see how the margin, which used to be negative from 250 56%, it has come down to negative 21%, and the company has a very bullish and FY25 annual operating plan, and they seem to be tracking very well towards it as well in terms of breaking even in a couple of quarters, as well as clocking a good growth number as well of about 3,000 crores of revenue. Coming to Mobile Premier League, again, Mobile Premier League, despite all the regulatory challenges, the company continues to perform. I mean, they have put basically the GST issue behind them. They have moved on. The company has reported both in India as well as in its European business strong growth and EBITDA margin of about 14 to 15% each. And on a corporate basis, of course, the EBITDA margin is 8%. Company doing phenomenally well in terms of growth, especially in the European business. And the gaming industry itself is on the rise, and we're very content with their performance as well. Yeah, next thing. Yeah, Licious. Licious, as you all know, had a slow FY24, but with all the guidance from the board in cutting their burn and giving importance to reduction of burn over growth, they have followed that path, and now FY25 they have begun their path of growth. As you can see in H1 FY25, they've already clocked a 13% YOY growth number, and also reduced their burn by bringing in various efficiencies in their processes. Further, they have also forayed into offline expansion where bulk of the meat buying happens. They opened their stores under their own names in Bangalore, and also acquired a Bangalore-based retailer, My Chicken and More, again at a very sweet valuation, which gives them access to about 22 to 23 stores across the city. So the company is definitely very focused on expansion, as well as mindful of the burn that they are tracking and working on reduction as well. The company is very well funded in terms of cash and can easily support their burn for the coming almost 2 years. Some of the smaller part of our portfolio, TBO Tech, and the last one being Aadhaar. TBO Tech is a listed company. We had invested prior to the IPO, just 2 days before the IPO. So we had a 6-month lock-in. We had invested at the IPO price of 920 rupees, and the company is tracking well above our IPO price, and also growing phenomenally. Our 6-month lock-in period ended in about 2 weeks back in November. We can exit now anytime, but we think the growth prospects of the company are very strong. The brokerage reports also are giving numbers anywhere between 1900 to 2070. And if you have tracked recently the company, it delivered about 28% growth, especially about a 36% growth in the hotel segment, which is a high margin segment. So they're growing well in segments which are adding to the EBITDA. And the company also opened its subsidiaries in Indonesia and Australia, sticking to their philosophy of expanding across the world as they cater to clients across the world as well as inventory across the world. So that matchmaking that they do, having presence in every geography very much helps them and gives them deep network. And this entire business is about the network effect which TBO Tech is able to wield. Housing is a very small investment. We had invested about 7.5 crores as an anchor, and about 2.5 crores what we got from the IPO application. IPO was heavily subscribed, and so totally about 10 crores of investment. The company again did very well. We invested at 315 rupees of IPO price. It's tracking at roughly 433. The broker reports are anywhere between 530 to 550 rupees. The company delivered growth and also improved its asset quality as well. So overall, the company has been delivering well, and we're quite and we will be tracking this company again. We had a lock-in which is over 3 months prior, and we will continue to track it, and we'll take a call when we need to exit this company as per certain price targets that we have in mind. Finally, ending with our brief snapshot of our companies. Most of our companies have become profitable, and the four companies, as you can see below, are focused a lot on reduction in their burn. Swiggy, Licious, Verse, they have come a long way from the burn that they used to have to what they are seeing today. API has come out of its debt issues and now working solely on its growth as well as profitability, as Dheeraj pointed out earlier. So we don't have any corporate governance issues in our company. Very happy to say that, and the founders have been resilient in the way they have gone through the fund winter and IPO cycle up and down. And many of them are preparing for an IPO, like Pine Labs and so on. So or SMT. So very, very happy with the portfolio. Now we are in harvesting phase, and as you can see, and many of these companies are also lining up towards that exit. So our harvesting time is also lining up with their exit timelines as well. So that brings me to the end of the presentation. Happy to take questions now. Could you please populate your questions in the Q&A window? So there's a question for Swiggy. When are you planning to sell Swiggy and at what price? See, our compliance doesn't allow us to tell the price at which we would like to sell. We are tracking it. Given the growth it is tracking at 30%, YOY, we see there is a lot of growth potential in the company. We will take a call. We have certain price targets in mind that we cannot tell. As I said, we can exit anytime we want. So we will take that call accordingly. Valuation. Somebody wants to see the valuation slide. So just go back there. This is what is the current overall return on the investment? As you can see, given the valuation data which we are using as of 31st December 2023, which is almost a year back, we are at a 1.12x on the portfolio. So this is a slightly dated valuation. When we do, and as per that, the return will be what about? That's about 12% return on an absolute basis. But this is not the right reflection. As I said, this 12% doesn't take into account NSE uptake or, for example, other companies' uptake. And because these are 1 year back dated valuations, the growth that they're tracking, but the real valuation you will see when our valuer values it in December or again, and you will start seeing in March again. And that's why we want to show you the stress test slide, which shows you the NSE uptake in mind, which shows you about a 20%, 1.2 times MOIC, which will be about 20% return, not taking into account, that if Pine Labs gets listed at whatever price, we ended at $3 billion valuation. There are news articles of, and after us, there was a round which happened at about $5 billion. And if the news article which talks about a 6 billion, we can see a healthy uptick in Pine Labs as well. Daily Hunt is at 1.25 times. Now over there, the way the company has tracked its growth as well as its burn, we can see again a very healthy uptick in valuation. So those things are not in the current NAV that unfortunately we cannot change the NAV quarterly. So as I said, and I've kept on repeating in every quarterly call, that in private equity, the valuations don't change quarter on quarter like the way public market does. And our valuations will remain stale and will get updated only once a year and will not be able to change every quarter. But we try to give you the stress test page regularly to show you where we stand. There's a question on when do you plan to exit NSE?
So NSE as well, from a liquidity front, there is no challenge. We feel we could potentially exit NSE even in today's market. However, we feel again, though there may be some correction in the underlying numbers of the company, but as the company gets closer and closer to a potential IPO date, that we could potentially look at a exit event closer to that date or even after the listing, depending on when the actual IPO happens. But in NSE's case, at least liquidity is not that big of a challenge as compared to other companies. And therefore, at this point of time, we are still holding on, completely aware of the fact that the performance for the December quarter and potentially the March quarter could be lower than the previous quarters. But I think there is still some amount of buffer left and other further growth coming through after that, which we feel we should capitalize on in NSE.
See, the whole point is that we are not in trading. We have taken certain calls in these companies and the performance on these companies. And when the incremental return from that price point is not there, is when we will exit. The fact that we are Cat 2 funds and it gives us the flexibility of exiting anytime if we have held the company 6 months prior to the IPO is a good optionality, but we would still like to stick to the fundamentals of that, when the company cannot give incremental returns beyond that price point, we will exit, which is what we have done, for example, when we exited Tata Technologies or Cyan, DLM or Nykaa and SBFC. And while they were small, but that's the principle that we have followed as well.
If there are any questions, request you to put it in the Q&A box and we'll be happy to answer it. I think there are no more questions at this point. Thank you everyone for joining us today evening. We will obviously keep you updated on any significant events in the portfolio and through our quarterly or newsletters or otherwise as well. Any communication that we need to do, we'll do that. And we'll meet again, I guess, in the next quarter after the December results are out in December. We'll meet again in sometime in either end February or early March. Thank you, everybody. Thank you.
Thank you, everyone.